Hook, in 2019, a 24-year-old nurse named Jessica invested $1,000 in a stock she heard about on a forum. Within 3 months, it was worth $0, and she lost everything. Hook_END, this isn't a story about bad luck. It's a story about a fundamental misunderstanding of how stock investing works, and it's a mistake that costs beginners billions every year. I'm going to break down exactly why Jessica lost everything, what the data actually says about successful investing, and how you can avoid being the next cautionary tale.
Pattern_interrupt, the stock market isn't a casino. But if you treat it like one, the house always wins.
The problem is, most beginners don't even know they're playing a rigged game.
Cliffhanger, so what really happened to Jessica? She bought a single stock based on a tip. That's like betting your life savings on a single horse in a race. The odds are terrible.
But here's the thing, she didn't know that because nobody taught her the basic math.
Pattern_interrupt, let's look at the real numbers.
Between 1926 and 2023, the S&P 500, a basket of 500 of the largest U.S. companies, returned about 10% per year on average. But here's the kicker, if you invested in just one stock, your odds of losing everything are much higher. A study by Bessembinder at Arizona State University found that from 1926 to 2016, just 4% of stocks accounted for all the net wealth creation in the U.S. stock market.
Pattern_interrupt, that means 96% of individual stocks either underperformed Treasury bills or went to zero. Let that sink in.
If you pick individual stocks, you're essentially betting that you can find one of the 4% winners. And even professional fund managers, people who do this for a living, fail to beat the market 85% of the time over 15-year periods, according to SPIVA data from 2022.
Cliffhanger, so if professionals can't do it, what chance do you have? None. Unless you understand the mechanism that actually works. Pattern_interrupt, here's the mechanism. Successful investing isn't about picking winners.
It's about owning a piece of the entire economy and letting time do the heavy lifting.
Imagine you're at a buffet.
Instead of trying to guess which dish will be the best, you take a small portion of everything.
That's what index funds do.
They let you own a small slice of thousands of companies.
Pattern_interrupt, the most famous example is the Vanguard S&P 500 ETF, ticker VOO.
For about 0.03% in annual fees, that's $3 per $10,000 invested, you get exposure to 500 of the largest U.S. companies. Since its inception in 2010, it's returned about 14% annually.
Not bad.
But here's where the magic happens, compounding. Pattern_interrupt, if you invest $500 a month starting at age 25, earning 10% annually, by age 65 you'd have about $2.65 million. That's not from timing the market or picking hot stocks.
That's from consistent investing over decades.
The math is simple, your money grows not just on your initial investment, but on the growth itself.
Cliffhanger, but wait, most beginners don't even get to that point. Why? Because they get distracted by the noise. Pattern_interrupt, let's talk about the hidden details that can destroy your returns. First, fees.
A 1% fee might not sound like much, but over 30 years, it eats up about 28% of your potential gains. That's the difference between $2.65 million and $1.9 million.
Second, timing.
According to a 2020 study by Delbar, the average investor underperformed the S&P 500 by about 4% per year over 20 years.
Why? Because they buy high and sell low.
They panic during crashes and get greedy during booms.
Pattern_interrupt.
Third, taxes. In taxable accounts, short-term capital gains are taxed as ordinary income. That can be up to 37% for high earners. But if you hold for more than a year, the rate drops to 15% or 20%. The simple strategy, buy and hold.
Don't trade. Cliffhanger, so what should you actually do? Here's the actionable takeaway.
Pattern_interrupt. Step 1, open a retirement account like a Roth IRA or 401k.
These accounts offer tax
advantages that supercharge your returns.
Step 2, set up automatic contributions.
Even $100 a month is enough to start. Step 3. Buy a broad market index fund like VOO or a total stock market fund like VTI. Step 4. Don't touch it. Ignore the news. Ignore the hype. Ignore the fear. Pattern_interrupt. History shows that the market recovers from every crash. Since 1929, there have been 20 bear markets, declines of 20% or more. Every single time, the market eventually reached a new high. The average recovery time is about 3 to 4 years. If you stay invested, you capture that recovery. If you sell, you lock in the loss. Cliffhanger, the final insight: the biggest risk isn't volatility. It's not investing at all. Pattern_interrupt. Consider this: if you had invested $10,000 in the S&P 500 in 1980, by 2023 you'd have about $1.2 million. If you had kept that cash under your mattress, you'd have $10,000, which, after inflation, is worth about $3,200 in 1980 dollars. Inaction is a guaranteed loss. Pattern_interrupt. So here's your forward-looking prediction: over the next 20 years, the people who consistently invest in low-cost index funds will outperform the vast majority of active traders. The data is clear. The math is clear. The only question is whether you'll have the discipline to follow through. Pattern_interrupt. Jessica's mistake was treating investing like gambling. Don't be Jessica. Be the person who understands that slow and steady wins the race. Start today. Automate it. And forget about it. Your future self will thank you.